Hello, Warriors. Alexander, how are you? Hugo, Mike Bergman, how's it going? Sinatra. Everyone do okay during the Fed, post-Fed?
Good early morning, Dale.
Good early morning, Kman. So lots to talk about after yesterday. And the first thing I could say is, see my charts, buddy?
Yeah, it's all there. And I see your alert on the cable.
Okay, yeah, there must be someone sharing this, but semiconductors, the whole market did well. I don't think anyone that was listening to us, especially yesterday, was short the market. Hopefully it saved you some pain and maybe you made some chips. And you know what, Kman, here's what I have to say. Yeah. I traded under the Volker tenure.
Yeah.
And Jay Powell, you're no Paul Volker. Okay, so he hedged. Inflation's a problem, but don't worry, we're not going to go 75 or 100, which he could change his mind down the road. But nice rebound in.
He was asked as much yesterday, right? They were
what's that?
To Volker.
Well,
conference.
Yeah, I mean Volker wouldn't have said, I'll do whatever necessary.
Yeah.
And he did it. So, he's acting like he's a dove in hawk's clothing. All right. So,
yeah.
What do you think?
The times have changed, but okay.
All right. Anyway,
there will not be another Volker. Good morning. There cannot be another Volker. That's a problem. No. But anyway, yeah.
Yeah. Anyway, I just want to straighten him out on his comparison. We all get delusional. Sometimes I think I'm Paul Tudor Jones. Okay, and I'm not. I'm sitting in a home office. So anyway, Vulcan, live long and prosper. So what do you guys think? I guess you have to say the big story is cable.
Yeah, I mean, Bank of England did an ultra dovish hike. And Bailey, even now during the press conference, is saying that people who think we are going for a lot more hikes, he doesn't agree. So he's not helping sterling at all. That's typically for Bailey. So yeah, they revised inflation much higher, growth lower. And what else? I forgot the third thing.
Inflation 10%.
Yeah, okay, but then they revised the growth low. Oh yeah, and unemployment to start rising again.
Yeah.
So I mean, you get like a triple whammy for the sterling right there, and that's what we got. Trading at the lows since 2020, and I don't see, unless dollar collapses, how we can get back to 126 from here in the short term, in cable at least.
Euro pound threatening a breakout here on the daily.
Yeah.
Right here. So to me, it looks like 87's a layup. Looks pretty good.
The problem with the pound after today's Bank of England was three things. One, they delivered 25. 25 was priced in, but there was a slight kind of outside chance for 50. That didn't happen. Then the three members who voted for 50, because it was a 6-3 split, they're members who are going to be leaving relatively soon. From what I read, I can't remember the dates exactly. So the Hawks are going to be going. And also they said that forward guidance that shows more hikes is not appropriate. Which for me, I read that and I'm like, oh my God, this is really bearish a pound. And unfortunately, I didn't do anything about it. And now the cable is 100 pips lower. But anyway, this is not good for the pound. I mean, any way you look at it, it's really, really not good. The question is, where do you stop? Where does this go? And
one thing we may add, just today, we have some local elections as well. And there's a bit of uncertainty surrounding that as well. So, and the market traditionally doesn't like uncertainties. So there's going to be an additional weight on the pound. I think seeing the amplitude of the move as well, I think we're going to find rally sellers quite easily in the sterling today.
Yeah, Dominic says 120.
Yeah, I like that.
These are very, there's two lows,
Big
one from
number.
2017 and one from 2020. Oh, actually, no, there was a spike below in COVID, but that was very short-lived. 120-ish, I think, is a very, very important level and or zone around there. So yes, I agree with Dominic.
Okay, so thank you. That's you know, you guys feel free. You know, that's what a community does. We share views. I know that we dominate it, but don't let us intimidate us. There's some great, you know, ideas coming out of F.A.C.E as well every day. You know, Stel, when you look at it, the only thing that's followed through is gold. So and silver.
Yeah.
So they turned, and especially gold. I mean, because the gold silver ratio is still, I don't know, looks like it may, I'm not sure it topped yet, but gold, nice rally from under, you know, what was it, 1850 low, 1848. So
yeah, I mean, yields are not breaking out. I think that's what's helping metals at the moment, but the dollar is rallying back. So, you know, we have these two forces kind of pushing and pulling. I'm not convinced yet. Obviously, they've had you know, a nice run yesterday and today, especially gold. But I still think we're chopping sideways. And but I have to say this though, regarding the Fed yesterday. Remember what I said before the Fed on F.A.C.E here. I said that, look, one bad print, the GDP print in the US, really shouldn't be enough to cause the Fed to, you know, to change anything in what they're telling us. And yet they ruled out now 75 basis point hikes. And now people might say, yeah, okay, but they can still do 50s and keep going. Yes, but they didn't have to do that. And in my opinion, this is the first little tiny step towards
normalcy,
towards turning around on, you know, what they're doing so far. I really didn't expect them. I remember yesterday I did say, if you put a gun to my head, I think they're gonna, the chances of them starting to disappoint are rising, and they've disappointed yesterday. So I'm a little bit worried about the Fed, because really, with inflation where it is, yes, GDP, we had one negative print, but that's, you know, earnings growth is still pretty good. Unemployment is dropping. Yes, the economy is going to turn, because tighter monetary conditions inevitably cause the economy to turn. But at the moment, I didn't see really what would be the driver for them to change what they tell us, and they did. So I'm starting to get worried about them. And I as I said before, I think it's the first little step towards a U-turn. Now, when will the U-turn be? I wouldn't be surprised if it's before year end. And I know you can call me crazy about it, but you know, it could well happen. So I was surprised by the Fed yesterday, and I guess the market was a bit as well. Now let's see what they give us. We have payrolls tomorrow, right?
yes.
Yeah, we have payrolls. So that's another.
We'll see. We'll see what that. You know, I wanted to ask you guys. Just one more thing to Kman, because he brought it up yesterday. What did you think about the amount and the timing of QT? Kman,
yeah. So what I'm thinking about all this is that he disappointed the Uber hawks, the people who expected the most, and so we had like positions adjustments. He actually fell back on what prior to the most hawkish expectations were. So a QT start in June. Let's not forget that earlier this year the expectations for the QT start was like October, then August, and now they are starting in June. So in the context of the evolution of how they handle it, nothing has really changed. So he disappointed the biggest hawks by doing 47.5 billion instead of 95 straight away out of the gates. It did calm the rate markets, which might have been somewhere behind in the back of their mind, saying like, if we go 75, we are going to have the rates explode, and then mortgage rates, and they would get a lot of criticism over their head. Probably might that be in the back of their minds? Possibly, but at least we're getting a clear picture of how QT will develop. So starting in the 1st of June, that's what I said on the chat and on the and on the
Here.
On Twitter as well. And I said, okay, the hodlers have probably one last hurrah, because there must be some people who have to adapt positions. But in the global picture, to me personally, it doesn't change anything yet. They are still on the path, which is more hawkish than ever until February, March. But then February, March, all of a sudden, the expectations have been ramping higher. So there's one small step back, but to me, nothing has changed so far.
Okay. Okay, Blake. Just before take it over, this
for mankind.
That's what I was thinking. Yeah, Kman's a poet. Anyway,
morning,
you know,
guys.
yesterday.
How's it going?
Good, man. I just wanted to show that how high cannabis stocks went yesterday.
Oh,
and
look at you!
See, you say I trade them because I like to get stoned. I got long that just in case. The semiconductors didn't work, but
nice. Well, at least you can
anyway.
on your own.
I trade them because I smoke them.
Well,
can you know your product is what they used to say. You know, do research. Go into Nordstrom's and see what they're doing. So anyway,
well, I just want to say I got most of your commentary. Both of you guys, well, three of you guys, basically. Between Kman, Dale, and Stelius, I was kind of in and out because I was doing Steve's job. Just so you guys know, Steve he had to run off.
Slacker.
Yeah, I know, and I had to pick up some slack there, but I managed to capture a lot of your commentary, not everything. So if I say something and you're like, I already said that,
you could dupe it
on my desk really quick. But anyway, but the thing is we've seen the dollar really snap back today, and and Kman, I said something in the chat room, and I thought, it was all predicated on, the sterling. You had the sterling, pushing lower because of the Bank of England, then the dollar seemed to have caught on everywhere else. But I guess it was really recovering against most everything today. But you'd pointed out that the yen, the dollar yen was also, pushing higher. And, I look at this dollar yen and we talked about it yesterday as far as doing one of these, and we talked about it I don't know if we talked about it on the Face webinar, but we for sure talked about it on the morning edge. And I said, you got to be really careful shorting the dollar yen, because a lot of people are shorting it. I'm like, you got to watch for a move like this and this. And this is, what we got. We got exactly the dip to lows into channel support. And then, we're back at, 130. I still look at the dollar yen and I look at the yen just in general, and it is just, it's just weak. It's just, the yen continues weakness. But what are your thoughts here with other yen pairs? Because, I look at dollar yen and I think, yeah, it's holding up well. But I look at other yen pairs. Let's just turn it over to the euro yen really quick. This thing's not backing away. The pound yen's not worth looking at right now because it's obviously sterling, influence at the moment. The Aussie yen is back at the 618. You got the Kiwi, yen that's holding up. Canadian yen is holding up near its highs. And, when after all this dollar weakness that we've seen, or excuse me, the dollar strength that we saw today, stocks pulled back a little bit, but they didn't really pull back a whole lot. So if the stock market continues to rally, we continue to see this risk rally. I guess the question to you guys is, are we going to continue to see yen weakness? And my guess is, yeah. What are your thoughts there?
Yeah, I fully agree. As people in the chat room know, I bought it below 129 yesterday on the dollar yen. I think it's a temporary setback in a big upward trend.
Yeah,
and the trend is not yet coming to an end. To me, MOF will call the end of the trend. What also helped, excuse me, what also helped yen pairs higher today is, I don't know, because I think in Japan they have like elections coming up, summertime or after the summer, and Kishida was babbling for hours this morning and talking about restarting the nuclear plants to compensate for Russian supplies, but then another 150 trillion yen investments to go green, of course, spread out over a lot of time, but it's still spending, right? And only MOF to me can really stop the rot in the yen, unless Bank of Japan. But we have no Bank of Japan until the 17th of June. Unless Bank of Japan changes tack, which is still a possibility, I think, over the next in this coming year, because they are going to run so far behind the other central banks, especially if ECB starts to normalize as well. But so far, for me, the only one who can stop the rot in yen are the MOF. The market has a free, in between brackets, of course, a free right for lower yen right now.
Yeah. Oh, yeah. And I think so too. You know, it's interesting, Marco. So ask how you play longer term, the dollar yen. I saw a longer term dollar yen. I'm like, oh, I got to ask this question. I mean, do you look for like, 1,000 pip moves and risking 400 pips?
But where do you start?
What's that?
Where do you start? It's a fine plan to go short dollar yen for 900 or 1,000 pips target with a 400 pips stop loss. But where do you start? Do you start at 130 or do you start at 135?
Yeah, right. Yeah, good point. Yeah. So anyway, I don't know. I think the dollar yen, I would actually take the flip side of that trade. I'd put my stops below 125 and I'd be long looking for 140. that's how I would trade it. But that's because I think a lot of people are trying to fade this move, and I think it's gonna.
I think a lot of people do, and some have success in sterling yen, but that's because of the sterling is getting hammered.
Right, that has nothing
not
to do
because
with
of the yen is getting stronger. We are still at the $130 yen. Yes, we have retracements. We went up to 131.25. We went back down to 128.75. But those are like dollar retracements, not yen strength, because as you rightly say, look at the Canada yen, the euro yen even. It's the yen is not gaining anything, right?
Yeah, I agree. The yen still looks like.
But there will be a time. There will be a time, because I don't think we are going to go in a straight line to 150, let's say, for instance, in the dollar yen. But let's not forget that even if Powell ruled out 75 BPs yesterday, they still are going to do multiple 50 BPs. And where is Bank of Japan?
Yeah, they're
doing zero.
Continue to add liquidity and be easy with monetary policy. So hey, I'm sorry, I wanted to shift gears really quick before we get too much in the weeds regarding the yen. Everybody's caught up about the Fed yesterday, and you look at the dollar. And by the way, the dollar came off and it's below 102.50 where it turns bearish. Just so you guys all know that. And let me just show you a longer term really quick on the dollar index. So the one thing about the dollar index that we have to keep in mind is we rejected this 2017 high, right? So the 2017 high is on a weekly chart that rejected, big rejection. Now we are back below back around the COVID spike high, but it's really, see this black line here. I'm going to actually dot that. Let me make that like a little dash line. I think is good. Well, actually, you know what? Dotted is going to be better because I'm going to zoom.
It really hasn't done anything wrong yet.
No, it hasn't. You're right, and it's below the 102.50. That dotted trend line that you can see there. It's below 102.50 where the thing turns bearish. Now, I'd mentioned this before, and I did the show, the Pepperstone show with Chris Weston yesterday. And I alluded to it, but I wanted to expand on it here because I've talked about it with the ForexAnalytix subscribers already the last couple of days. What I really think is happening here with the dollar index is we are seeing, we're seeing this, this big rounded bottom, something like that. But actually, what I think is going to happen here is we're going to see a cup and handle pattern. So we're going to see a dollar pullback. and the dollar is going to, maybe come back down towards 100. But it's going to just be a launch pad for the euro to eventually make it to parity. That's what I think is going to happen over the course of the next, let's call it several weeks, because I think that yesterday avoided, let me go back to this chart. Yesterday, the Fed avoided tipping the market over off the proverbial cliff, if you will. And that's what saved us, below 4,100. I think that the stock market still is going to, spend the next, here, let me just draw this out really quick. It's going to spend the next couple weeks building out this right shoulder, from a equal time perspective. And, we're going to probably end up, probing that 44,000, 4,100 level in the next couple of weeks. But in the meantime, we're probably going to just, recover back up towards 4,400, 4,500, 200-day moving average. But that's why I don't want to be too bullish the dollar right now, because I think that stocks are going to still consolidate, and it's going to be hard for the dollar to really gain a lot of momentum when the stock market is just stationary, and you're having people rethink what the Fed is doing here as far as hawkish. Now, I'm mentioning all of this because the poo-poo. Have you guys ever had a poo-poo platter?
What the hell is that? What is that?
No, you haven't? Oh, it's an Asian.
I've heard of it. I'm not sure what it is.
It's an Asian food, like appetizer plate.
Okay.
Yeah. Anyway.
Yes.
James said I have. See, I looked up to see if anybody commented there. But everybody's, yesterday we had the Fed. Fed kind of poo-pooed the hawks, if you will, right? But the hawks are going to come out and talk tomorrow. So we're going to have a lot of commentary. If you look at tomorrow's calendar, we got Williams speaking. We've got Bostic is speaking. We also have, and I don't see him. Where is he? Oh yeah, we have Waller speaking. We also have Bullard speaking somewhere. I thought I saw.
Yeah, they're at the Hoover Institution in Stanford University, talking about how monetary policy got behind the curve and how to get back. That's the
well,
Let me put the link on the chat.
Look. I mean, the thing is you got all of these speakers coming out to play tomorrow, so it's going to be really interesting to hear their opinions, right? Because they got the poo-poo platter yesterday. And so they're going to come out swinging tomorrow. So you got to think about that. You got to think about that going into the end of the week. This is going to be one of those things where we might actually see some volatility even post jobs report tomorrow. So shifting gears one last time. We had a lot of volatility in the dollar. We've seen the dollar, and this is again what I think is going to happen in the dollar. Doesn't mean it's going to happen. I just think that the dollar is going to stall around these levels, and we're going to be being able to pick up the dollar a little cheaper. I think the euro is probably going to recover back up towards the 106.50, 107, 108 area, and we're going to be able to just be on the short side up there, somewhere in a more strategic, better area, in my opinion. But in the meantime, we have something bigger happening, and that's tomorrow. We got the jobs report. So what are you guys going to do? What do you guys think with the jobs report? Because I think data matters now. Again, this is where and I know I said this on the week ahead video, 4 days ago, but the jobs report is going to matter. We're going to be watching not only the employment data, we're going to be watching wage data, and how important to you guys is employment at this stage of the game? What are your thoughts here?
Yeah, of course, I agree. Wages, participation, the U6 unemployment rate, the minorities, because Powell got again asked questions about it yesterday, and those are things that they are watching. So it's going to gain in importance again, let's say. Perhaps more those wages and the other indicators than the actual headline number again.
Yeah, I mean, I think so too. I mean, that's where, you know, you have to really start watching this. Now, what, and I'm going to ask, and Stelios, I didn't hear your commentary if you had any, but if you wanted to jump in.
Yeah, I think you're right. It's going to matter, and we had some evidence. I think that the Fed is definitely getting affected by the economic data. You know, the GDP print may have skewed them a little bit or influenced them a bit. So I think if we start seeing weak payroll prints, that's definitely going to give them another reason to take another little step towards a U-turn. So I think it's going to be pretty important tomorrow.
All right. Well, I think it's going to be pretty important as well. And so, you know, the thing about that data is, you know, I guess I'm going to ask you guys this: what is good data? And when I say good data, what is going to give the dollar the biggest boost? And by the way, the sterling is hitting new lows right now. I literally got up after the Bank of England made their announcement. You know, it's this time of year, so it's like I was just dragging myself out of bed and to get you know, some coffee, and you know, we were already trading at 125 when my computer fired up, and I was sitting here. We were already trading at 125. We're at 123.70 right now. We've dropped 130 odd pips since the Bank of England, since I got in front of the computer. And I know that's not just it. We've had really a 250 pip move or so.
24 hours.
I mean, huge move in the sterling right now. And I know you guys said it. I mean, I heard you say it, Stelios, and I heard you, Kman. I mean, you guys are like, man, this is not bullish for the cable. And you are right. I mean, this thing is just getting demolished. But I gotta say, well, I got to ask you this. I got to go back to the data. What data is going to be good for the US dollar? What's going to be bad for the US dollar tomorrow? Like, is a strong headline number, is that good for the dollar, and a strong headline number bad for the dollar? Or is it more than that? Are we going to have to start looking, you know, is the wage data going to matter? You know, what are you guys thinking?
I think a strong number is definitely good for the dollar. I mean, that's without doubt for me at the moment.
But do you think that data is going to weaken a little bit moving forward?
Yeah.
I mean, is that what you guys think? Tightening
monetary conditions will weaken data. I mean, that's been proven right every time. How long, you know, when does it start? What's the lag? That varies, but I think it will weaken. Will it be this print or, you know, 3 months from now? I don't know, obviously, but I think it's going to start turning.
Okay. Kman, do you have any ideas there?
Yeah, and on Stel's lag, is it not something like 3 to 6 months lag or so, Stel?
Yeah.
But that's modeling, right? We are in accelerated economic development since the pandemic, so it might be 2 months.
Yeah, I mean, the problem is that, as we've said before, disposable income, the average disposable income is getting lower and lower, energy prices going higher, and mortgage rates are going higher.
Absolutely.
That's the big problem. So I think eventually it's going to turn. It has to turn. Yeah. Will it be, like you said, is it going to be the usual 3 to 6 months, or is it going to be accelerated because we're going faster than other times? I don't know. But
yeah. That's a question.
I think we have to worry about. Go ahead, Kman.
Oh, sorry. No. Go ahead, Dale.
No, I just, you know, as Blake will call it a dad's joke, but I heard that my father-in-law, when he could have refied all this time, is looking at doing a refi. So if there's anyone to fade right now about rates, it's that people are starting to panic that rates are going to go sharply higher. And, you know, you had a year or so with real good, you know, terms. And now now he's going to do it.
Oh my gosh. So, yeah. The best, like, I can't imagine somebody's trying to refi right now. I mean, I think I got my home loan. I refied it like near 2% or something. Yeah. Crazy. It's like the sad thing is when you do that, it's like, okay, I can't. And I was talking to actually some realtors about this because I'm not a real estate investor. It's one of those things I really should have, you know, learned about at some point, but you know, it's not something that I actively ever sought out. But you know, I talked to a lot of realtors because we live in a hot real estate market, and they're like, yeah, the problem with everybody that refied at those levels. No one wants to sell. Like I look at my house and I'm like, yeah, why would I want to sell and move? It's like I got my loans are dirt cheap. You know what I mean? Like, why would
they'd have to lose it for it to end up on the market.
Yeah, I mean, it's
that's
like,
the only way.
Why
where are you going to live cheaper?
Well, that's one of the reasons why people worry about the real estate market's going to really slow down, because so many people are in at good rates that no one wants to move now. Anyway, but that's another story. But that's funny, fading your dad. I got that. But let's. I wanted to share with you guys one thing really quick. I shorted the dollar mex yesterday after the headline. The headline number came out. We slumped to like 2015, and then I sold a little bit right there. I was driving. I was on the other side of town, and then before Powell started to speak again, we moved back up to 20. I can show it to you exactly where it happened. If you look at this this 15-minute chart, we kind of sold off. Then we came back up towards like this 2020, 25. We actually went high. I didn't think we went that high. I wasn't looking at charts. I was just looking at quotes. And then I sold some when we were at like 2022. And then I had to turn off my phone because of where I was at. Anyway, we dropped and we broke down in the dollar mex. And the one thing I need to point out with the dollar mex, and the reason why I'm bringing this up is because you really want to watch the emerging market currencies. They've really outperformed the market a lot. I mean, we've had, the S&P that was near 4,100, and in my opinion, the dollar Mexican peso should have been trading way up here, way around the 2150. Never even got even close. I mean, we rejected the 50% retracement right here. And this in itself is like a continuation pattern now. So you can you should watch it, because if the Mexican peso, South African rand, you can look at a multitude of emerging market currencies. If they catch a bid, you do not want to be short risk, and you probably don't even want to be long dollars in a situation like that, in my opinion. So watch these emerging market currencies. They have been. They have a great carry, first of all, and they're trading really well, and that's usually a risk on type of indication. So just keep that in mind, everybody moving forward. Oh, you have an interview, Dale. I'm sorry.
Yeah,
I just realized what time it is. I want to thank everybody for supporting us. Make sure that you try out ForexAnalytix, $1 for 10 days. Check out the Trader Funding Program if you want to see how you can access larger trading accounts, with just an assessment fee. I just saw somebody else pass today. They got funded for a live account, so you can access different live accounts with just a small assessment fee and trading in a demo environment. Watch this video of me down below. If you want, it's like a 2-minute video, and it'll tell you all about it. So Dale, have a great interview. Kman, thank you for all your views. Stelios, not so much. Dale, thanks again. I'm just kidding.
Okay, buddy.
Stelios, I love to harass Stelios all the time. We love him. Thank you for all your views, and team. I'll see the rest of you on the Morning Edge in 45 minutes.
Have a great day.
Okay, everyone. Thank you, team. Alex, welcome back to F.A.C.E. How are you, buddy?
Hey, Dale. How you doing? Can you hear me?
Yeah, I got you.
Got me loud and clear? All right.
Loud and clear. Do you want to share your screen?
Sure.
Okay. What's on the radar, buddy? With the Fed and yesterday.
Let's I just put together a little chart deck this morning that I could run you guys through some things that I'm looking at.
Thanks for the effort.
Yeah, but I got a question. Was that a life-size model of Boba Fett that I saw behind Blake Morrow in that video?
Yes, it was.
Man, that's sweet.
Alex, and good morning, and thanks for joining us. I'll tell you just real quick story. My teenage kids at the time were teenagers. They're like, this is when Star Wars, several years ago when they started the whole new series. And they're like, Dad, what are you gonna, what are you gonna be for Halloween? I said, you know what, I'm gonna build, because they love Star Wars. I'm gonna build a Boba Fett costume. They're like, yeah, sure. And I'm like, no, I'm really gonna build one. I'll build one for you guys. So yeah, it took me like 2 years to build it, and then I wore it during COVID for Halloween, and went around the neighborhood with Boba Fett. And I'll tell you, I'm 20 pounds too heavy. I'm not my ex-military weight anymore. So Boba Fett was like kind of chubby Boba Fett.
Bring it to the tailor, they'll let it out for you.
Anyway, that's the story. All right. Hey, thanks for joining us, Alex. And
good eye, Alex. Good eye for costumes. How about markets here, buddy? I'm still not seeing your screen.
You're still not seeing the screen? Let's see.
Yeah, click that green button.
Yeah, share screen. Okay. There we go. You got me?
All right. Yep. Got
it. All right. So the name of the game for us, I mean, we're a little bit, I think, longer term focus than you guys, a little bit a mix between investing and trading. And so since the end of last year, our kind of MO has been for a volatile sideways regime in the market. And that's the best that we can hope for, which luckily has mostly played out. And so I'm just going to walk you through kind of like we'll start at the 30,000 foot and, zoom in down to the Nat's ass level, and just kind of give you a scope of what we're thinking about. But so just here's our just kind of bread and butter macro ops growth composite model. It's just composite of 13 different indicators that look at the economy on just straight data metrics, financial metrics, liquidity metrics, and some relative market moves. And so we've been in kind of a slowdown regime for the last 6 months or so. You could see that over here.
Average
but it's also
peaked in Jan. Yeah.
Yep. And I mean, nothing surprising there. It's still elevated, well above the zero line, which is where you get into kind of recession concerns. So there's that. Just another way of looking at the Conference Board leading economic index. Again, it's coming down, but from very high levels, it's still elevated. So I mean, we've been seeing a lot of recession risk. Talk about yield curve inversion over the last 6 months. That is not a concern for ours at all.
A lot of people, Alex, since you bring that up, the inversion, a lot of talk about the great steepening to be the next play. Do you agree with that?
I think it's possible. We've been really focused on not having strong opinions, and opinions that we do have, holding them very weakly, just because we are probably in the most noisy macro environment we've been in our lifetimes.
Well, how old are you?
38. So
I
have a couple.
You've only seen 18 years of market history, huh?
Yeah.
And you're talking about a lifetime.
Yeah. Well, I would
no,
say
you're very experienced compared to a lot of people out there. I'm just giving you a hard time.
I would say as a student of market history, it's probably.
Okay. There you go.
It's probably up there with even the ones that you've been through. But that's just speculation on my part.
The panic in 1908 was pretty wild, but
I'm sure you have a lot of stories from then.
Go ahead.
Okay, so the LEI is coming down, but from high levels. Still, again, not a ton of recession risk, but historically, this is one of the worst macro environments for just equity returns, which you can see here.
Yeah.
Generally, it's about flat to negative, depending on the regime. Here's our recession probability model. Looks at the probability of a recession going out over the next 24 months. It's a Probit model with 13 indicators that looks at everything from corporate profit margins to investor leverage in the markets to hard economic data and so forth. A recession isn't going to happen. So generally, I mean, this is just to build context, right?
I like it.
Going through everything. Here's our bear market probability shock. So you can have a bear market without a recession. They're rare, but they occasionally do happen. And as we can see right here, it's very elevated right now, and this is looking at things like rate of change and interest rate moves.
Yeah.
War is not directly a factor in this model, but it's definitely moving the variables like inflation, the rate of change in inflation and interest rates. So that is the big macro takeaway. Here we have our inflation model. What we can see, this is different leading inflation indicators. The blue line is our leading inflation composite indicator. It's peaking. We could see that in the sub indices right here, but there's still some variables that are moving higher. And so, our call is we probably would have seen inflation. We definitely would have seen inflation peak in Q1 of this year. The Russian invasion that definitely, threw a wrench in those gears and has changed that. Our call is still that we see inflation, especially the Delta, come down. But it's probably going to remain elevated, until, it's just like, again, it goes back to the difficulty of this macro regime. You have tons of ships sitting out the coast of China because of their lockdowns. It's screwing up supply chains.
That's intentional.
It could be, yeah. It could be. There's definitely some credible theories going around about why that is. And then obviously everything that's going on with Russia and Ukraine and how that's affecting fertilizer and the ag market and stuff. Okay,
that's intentional too.
Yeah, you could be right, Dale. You could be right. There's
everyone wants to see the king taken off the throne. It's always like that, right?
Yep.
So just call me Elvis. Anyway, Alex, so these are interesting because, a lot of people think when people say inflation has peaked, that it means prices are going to go down, and it just means the rate of change of inflation continuing to accelerate is peaking.
Right. And that's like a big, that's an important takeaway, right? Everybody's focused on the level, but mostly in financial markets, it's the delta, the rate of change of what we're looking at that matters, because the level is already priced in. That gets embedded quickly. And that's especially true when looking at inflation. We're not so much concerned about the level. We're concerned about the rate of change of inflation. And so we think that, we've seen the peak in the rise in inflation. We're going to start to see that delta come down. So generally, that's kind of the broad macro view is, okay, a recession is not going to happen. Very, very low probability. So, you could just ignore a lot of the doomsday or recession callers out there. A bear market, a 20% decline from the peak is very possible.
Haven't we had that in many areas of the market, and even
right?
more?
Yeah, and that further kind of convolutes the broader picture, right? Is because you've had massive growth names just get kneecapped, right?
Yeah.
Right. And so that's happened over the last 18 months. That hasn't been recent, even though that's kind of continued. So a lot of the air has already been taken out of this. I don't think there was definitely some pockets of the market that were bubblish territory, but that air has long been taken out. So I think we are getting closer to a major bottom in the market, and that's our general call. But we still need to see, for me to get comfortable saying that we're there, we need to see that kind of final washout, capitulation, liquidity reset. See yields find a ceiling and stabilize. This is like the slide I'm showing you now. Liquidity, we look at it a number of ways, but like the rate of change on high yield debt, on BAA yield, the spread on LQD, IEF. So all this stuff it's just liquidity has tightened up too quickly, and that's what's been weighing on markets. And so we need to kind of see. I'd like to see a flush. Maybe one more leg down and then a big reversal, and that would make us more comfortable. But until then,
we could have had that flush yesterday if Powell did not make the comment that they're not going to be more aggressive than.
Yeah, to be honest,
it was right on the cliff. It was right on the cliff.
Yeah, and I think he probably would have been better off if he wouldn't have done that. I don't think he's doing himself any service by slow walking this thing, because he's been
a dove in hawk's clothing.
Yeah, no, I mean, he really is. And he's been, chasing the market for the last 12, 18 months. And so you would think that he would err on the other side finally. But.
Yeah. See, that's your net. It's, he went back to his default position. What about all the wealth that's been decimated and destroyed in sovereign bonds, in the junk bond market, in the corporate bond market, in the muni market? Do you see any, like credit events in your, say, binoculars or telescope down the line with, how leveraged everything is and this rate of change in rates, even if they're peaking here, could set off?
Yeah, so certainly, right? I mean, I was looking at a report that Bank of America put out the other week, and they were, showing essentially like the global aggregate bond and credit market has seen their worst, worst, I think, rolling 6 or 12 months since 1920, and so
no one's talking about it.
Right. Yeah. And so that's significant. Typically that what we see happen in like big moves like that in the bond market, they tend to have a long lead time on the rest of the market.
Okay.
And so can that show up in a further, liquidity
6
pocket
months.
kind of right and down in 6 months? And I think definitely, I think you're spot on, Dale. But I would say, it all depends on the reaction function of, the game masters, Powell and his team and the other central bankers, and how they, react to that data when it comes in, if they're all doves in hot close, which I kind of suspect we are still in a new policy regime and that we're seeing a lot of tough talk. But I don't think that many of these game masters are willing to do the actual work to reverse their errors. So, here we are. But
I just think that's a big story people aren't talking about, and and the extremists are talking about like sovereign debt crisis. The biggest buyer is no longer buying.
Yeah, I'm not too concerned about that. I mean, I think it's on a case by case basis. I think it depends on what country we're talking about. On the US, I'm not too concerned just because the entire system is still very much structured around holding dollar. US treasuries and the dollar is the ultimate safe haven asset. So we're a long ways off from that.
That worries me. Everyone thinks we're safe. Okay, so trend fragility is low.
Trend fragility is low. Again, this is just a composite indicator of different sentiment positioning and flows. But we could see it hasn't hit the capitulation levels that you typically see at major bottoms. It doesn't mean the market can't, rally back up near the highs. I mean, that would be very typical of a sideways volatile regime. But this is just another sign that I don't think we're yet at a durable bottom, but we're getting close. Sentiment and positioning, here's just some of the parts of that indicator. We've seen hedge fund positioning really come off over the last week, which is interesting, and we're getting close to kind of what you see at the different lows. Aggregate US equity fund flows, again, getting close to that green line. This is where we see capitulation. Everybody's been talking about AAII, net.
Right.
Sentiment, that's been very bearish. So that's a one of the preconditions for a major bottom, but it's not like a catalyst for one, right? So we need to see these other things. Put call ratios are still relatively elevated, and then same with name average equity exposure. So again, this is just kind of this suggests that we're getting closer to a larger durable bottom in the equity market, but we don't have the capitulation for one yet. So just something to keep in mind.
Could that have been a bottom, enough of a bottom to propel the market to new highs from, say, for the Monday's low? That reversal, false breakdown under 4,100. I know a lot of people are looking for that 90%. What is it, volume or breadth down? The swoosh. But maybe we haven't had it because we haven't peaked.
Right. And so, I mean, in markets, anything is possible. We're just concerned with what's probable. I think, we're definitely at the lower end of the range near major support. We saw an over 8, I think it was an 80% upside volume day yesterday in exchange. So we'll have to see if we see, we've seen plenty of those year to date, but we haven't seen the second consecutive follow through day, which you need for a classical breadth thrust.
Okay.
So we'll see if we get one of those today. So right now we're just kind of, playing in, we've been a lot more short-term focused than we typically are year to date. So just playing for, short-term swing trade. So yeah, we're buying little bits right here to see, just playing for like a move up towards kind of maybe the middle of this long-term sideways regime. If we get a breadth thrust, like if we get that confirmation today, then we'll get more aggressive to the long side. So yeah, here's just kind of the chart I'm looking at. This is just the Qs. I'm seeing major support at the 1200-ish level around there. Again, like if we got a washout down there and then a reversal, that would make me a lot more excited to start aggressively buying, because there are some, especially in, I think the growth names are getting really interesting from a positioning sentiment standpoint. And if you have to dig in, because there's still a lot of just total garbage, really bad business models, but there are a lot of really good names trading for 7% free cash flow yields, growing upwards of 20%. Revenue growth.
I like that chart too, Alex. Would you wait for some green to start showing up? I mean, even yesterday on the bottom, you don't see any green.
Yeah. So this is the SQN market regime model. It was developed by Van Tharp, and so we use it to identify what regime the price action is, and it works for any asset class, right? So right now it's been in a bear quiet to bear volatile. That's what these red bars see. And typically the best returning regimes for the long side are bear quiets, which is the light green. So yeah, we would like to at least to see it to move into neutral. Again, that's just another, technical indicator we look at, be like, okay, now I think, the trend price action is changing. The feel and tone of price action is changing. It's a lot more favorable to the long side. Again, this is just our breadth thrust page, something we check in every day. We can see here, we got oversold conditions in the McClellan oscillator, percentage above 20 and 50 day. So we got preconditions for a very temporary low. Boom, buy, add a little bit yesterday, today. You could nestle in stops right below yesterday's low. But we want to see now breadth thrust. We want to see that second consecutive 80% plus upside volume day to day. We want to see, get a broader MACD buy signal. Again, we want to see these spike. We haven't seen those yet. Sectors that we've been focusing on, we're just looking at what's working, where's the trends working, both on a fundamental basis and technical basis. We like to look at forward relative earning per share trends. It's not rocket science. Energy has been the clear winner of the last 18 months, so we've been heavily focused there. Materials are still doing really well. Surprisingly, the relative earnings trends in semiconductors are actually holding up. So that's something to keep in mind. I know AMD just reported the other day, and they put out good numbers. And Infotech is holding up. I know you guys like to focus on currencies. We wrote up the long case for going long the dollar versus the renminbi a couple weeks ago. That ended up breaking out. Yield differentials here are back in favor of the US dollar, to the greatest degree since over a decade. So that's really interesting. The dollar, I just think that this is, is
this a breakout here, Alex?
Yeah, I actually think it is a breakout. So we're long the dollar, and it's extended on a short-term basis. But you just look at the price action relative to the narrative that we've been seeing, about that dollar losing its global reserve currency status. And so obviously there's the narrative is not matching what we're seeing. So
Right.
yeah, like we're long the dollar. We've been taking a little bit of profits here. We'd like to wait for a pullback to the midline of
You
the
have any
Bollinger Bands on a daily.
long-term outlook, targets, objectives on this chart?
Yeah, I mean, just going off of measured move target off of this larger monthly pattern.
Yeah.
I mean that gives us a target of 115. On the trade weighted dollar. So I think that's very possible. And then especially like you look at what's going on in the world. Well, Russia has really hurt the emerging market trade. And then what China's been doing to its tech sector and with its zero COVID policy, that's a big weighting in the emerging market indexes, right? And so that really hurts the emerging market trade. It's going to hurt the growth in the rest of the world. So if you're looking at everything, right, you have to look at everything on a relative basis. Well, the U.S. is starting to look better and better. Now, I think I heard Blake talk about some of the strength in some of these select EM, currencies and stuff, and that's definitely true. So it's a case by case basis. I think Mexico and Brazil are very interesting. Mexico because it's going to be a long-term secular beneficiary. People moving their manufacturing closer to home as we move to away from globalization to regionalization. Brazil, obviously, because it's a large agricultural exporter, commodity exporter, so they're going to benefit. But EM as a whole, look, U.S. did the largest fiscal impulse of the group. Our growth is our economy is going to stay stronger. But it's also mean that the Fed's probably going to be on a longer term tightening path. That's going to continue to put the squeeze on the rest of the world, especially these, emerging markets broadly are going to be out of favor for a while. So I think there's a real chance we move back into kind of a reflexive loop over the next 1 to 2 years. See these capital flows come back into the U.S., back into these, certain growth names with better fundamentals. And we see that higher dollar, higher U.S. versus rest of the world equity performance that brings down inflation a little bit, and that kind of maybe we get a positive reflexive loop there. So that's just something I'm thinking about. And then I just end with this quote that I shared with people the other day is that a lot of guys, especially longer term guys, have been getting chewed up year to date because they've been trying to play the same game they've been playing the last 5-6 years. You have to be flexible. You have to know what market regime you're in. And if you're kind of a long-term position guy, if you move into a sideways regime, then it's okay to sit on your hands, not be active, wait for the setup that fits your process.
Patience pays. Sometimes the right trade is no trade. Alex Barrow and Jesse Livermore. Really important thing for people to learn is to sit, and until there's something so compelling they have to go for it.
Right. Let the market come to you.
So I know you're only 38, but you have a lot of wisdom, Alex. I appreciate you coming here and sharing it with the F.A.C.E community. You want to show your website where people could follow you?
Sure.
It's at Macro Ops on Twitter, everyone. And this is where you could find
this is
Alex's website.
Macro-Ops. Follow me on Twitter at the same handle, Alex at Macro Ops. And you
want to show it?
This is it right here. So there you go. This is the site. Come check us out. Say hello. Thanks for having me on, Dale. Always a pleasure.
Okay, I'll get in touch with. Yeah, I'll get in touch with you, Alex. Have a, always root for you. Have a great rest of the spring trading season, and we'll talk again this summer.
All right, sounds good, brother. Take care.
Good
God
luck.
Bless.
Good hunting. God bless you too, bro. And remember, everyone, don't just count your pips, count your blessings, and be patient, please. Okay, you don't have to make your broker rich. Make yourself rich. Adios, everyone. And you could join the team in 16 minutes on the Morning Edge. I'll see everyone. Bye-bye. Thanks, Alex.
Thanks.